Joining me now, Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Art, always great to have you.
Well, terrific to see you, and congratulations on the Buffalo win this weekend.
Thank you very much, Art. All right, let's talk markets. Last week's jobs report, of course, caused stocks to stumble, but they're still sitting near record highs. S&P 500 trying to regain some of those losses right now. As we kick off this new week, Art, how are you feeling about the market?
Well, there's three things to think about. I think the market has plenty to be concerned about in terms of the near-term inflation picture, and we'll learn more about that this week with both the CPI and PPI. But I think the Fed, in a sense, is really focusing on the labor market more than stable pricing, because they'll look at core goods pricing as being a one-time event because of trade. Speaking of trade, unfortunately, trade is back to the unknown because the appeals court pushed this out and now probably gets taken up by the Supreme Court. So we won't know the rules of the road on the trade war highway until October sometime. So I think that causes some unknown. And when we have unknown, we have corporations that don't create new jobs, and we have consumers that pull back a little bit, and we have investors that want to stay on the sidelines until we know what the end of that is. But I think for this week alone, the biggest news we'll get will likely be the CPI. Hopefully it doesn't come in scorchingly hot and change the narrative around a September rate cut. It would have to be an extremely higher than expected number for that to happen. Away from that, we'll get the annual revisions of the labor market. So once a year, they try to basically consolidate the household survey with the institutional survey and figure out exactly how many jobs were created last year or over the last 12 months. That always causes some headlines, but I don't think it's anything that's going to move markets around.
The Fed is widely expected to cut a quarter point next week, but there is starting to be this narrative of potentially a half-point move. What camp are you in, Art?
Well, I think the Fed's going to cut 75 basis points this year. They may well front end load that and go 50 basis points at this meeting and take the October meeting off and then go another 25 basis points in December. The reason I think they would front load it is we saw the weakness in the labor market tick up in the July jobs report, and had the Fed had that report, which came out 2 days after their July meeting, they probably would have cut rates already. So I think that when we sort of think about the cadence of what the Fed would like to do, there's probably about 125 basis points that they'd like to remove from the Fed funds to get to a neutral level where they're not restrictive or stimulative. And if they can get that done by getting 75 basis points done this year, they may well do that. Right now, the CME FedWatch tool shows that there's about a 90% chance that they'll go 25 basis points and a 10% chance they'll go 50 basis points.
So, Art, if and when the Fed does cut, what sort of market reaction do you think that we'll see? Is it already priced in at this point?
Yeah, that's such a great question. I think you framed it up perfectly. The market's anticipating this and has been since the July jobs report came out. So therefore, we're starting to see small caps do better, mid caps do better, interest rate sensitive housing stocks do better. I think that will continue with the confirmation of the rate cut and the language coming out of the press conference and the statement and what we see in the new dot plots that we'll get. So I think that we've already started to see some of that reaction. It's beneficial to small caps, and they've been underperforming for quite some time. The housing stocks have been under pressure, and they're starting to see a bid. So I think the interest rate sensitive sectors will continue to broaden out this market.
You know, you mentioned that there's plenty to be concerned about, whether it be trade uncertainty and the unknowns around there, whether it be the labor market, obviously the inflation picture. But then I was taking a look, and you're holding your S&P year-end target of 6,600, which implies, not much upside from here, but also not downside. So explain that 6,600 price target.
Sure thing. So yeah, we can go on a bumpy ride between now and the end of the year, and I certainly think September is historically that time we may see that. I think we have plenty of catalysts on the short-term horizon to give us that sort of 5 to 10% pullback, which would not surprise anybody, I think, in the month of September. You mentioned a couple of the things that might drive that. The uncertainty around trade is certainly a large catalyst that could be a headwind for markets. But away from that, it's just how weak does the labor market get before it stabilizes? And I think one of the drivers in the weakness in the labor market clearly comes from uncertainty around trade, keeping corporations from creating new jobs. But the other is we just don't know how much in the near term artificial intelligence is starting to take away those entry-level jobs from new college grads. So right now, that unemployment rate, that 18 to 34 demographic, has an unemployment rate that's about 10%. If that continues to be a trend, and we haven't sort of made that transition such that we're finding new jobs for new college grads, that can continue to show weakness. On top of that, we've got 11,000 baby boomers that are retiring every month. So the demographic, the workforce demographic, is really unclear right now. Add to all of that is we've got much less immigration. So last year we needed to create about 150,000 jobs a month to keep unemployment unchanged. That new normal may be about 50 to 75,000 jobs. We're below that right now. If we remain below that, we're going to continue to see unemployment rise.
Okay, so it could be a bumpy ride to 6,600 then. What would you buy on a pullback, and what would you buy regardless if we see a pullback or not?
Yeah, I don't think this sort of weak September or the normal sort of 5 to 10% pullbacks should change your long-term investment views and positioning. But if you are under allocated equities right now because you've been nervous about all sorts of things this year, it will give you that opportunity to have an entry point. We certainly think the three things you want to think about are the winners in artificial intelligence clearly are starting to emerge. And it's not just NVIDIA anymore. Companies like Broadcom are certainly showing that they can do well. But I think the biggest name that is giving you the best entry point right now is Apple. And I'll tell you why. Three quick reasons. This Alphabet suit that just got thrown out of court means that Alphabet can continue to pay Apple to be their default browser on 2 billion Apple devices. That also means that Apple doesn't need to spend a lot of money developing their own large language models, and they can partner with somebody like Alphabet to enhance what they're doing with Siri. And then there's going to be a massive rollout at the end of the week of new Apple products. So probably the best thing that I could tell you is if you've missed a lot of some of these great moves that are AI adjacent, any kind of pullback in the month of September might be a great time to get involved.
Okay, so you said three names. I heard Apple, which of course is down, still 5% year to date. What are the other two names?
Yeah, NVIDIA is down 20% from its recent high. I certainly think that represents an opportunity. Every time NVIDIA pulls back, people start to get concerned about either competition to NVIDIA or CapEx spend is going to slow. Neither one of those things has shown themselves, and NVIDIA likely gets a license for the H20 to sell into China, which right off the top would be another $5 billion for those folks. The third name I'm going to throw in here is going to come out of the blue a little bit, but TJX, which is TJ Maxx and Marshalls, is the biggest beneficiary right now of this consumer uncertainty. Folks love the treasure hunt that is TJX. TJX isn't over-indexed to imported goods, and they continue to outshine the rest of the discounters.
Okay, all right. Yeah, TJX, though, up about, 16% year to date, so has already caught a nice bid there. All right, Art, final advice for investors right now with stocks at record highs, the economy showing signs of cooling, all this uncertainty that you mentioned in terms of the impact of AI on the jobs market. What's your advice to investors?
Well, I think investors should think about this as a journey and not a point in time. And unfortunately, because there's a 24-hour news cycle, we get to hear about the points in time a lot. You need to separate a lot of the noise from the news. And I think the news is more good than bad. I think once we get through the uncertainty over trade, we'll start to feel the beneficial effects of things like less regulation and knowing what the corporate tax rate is going to be for several years. I think those haven't shown up in equity valuations right now. And I think we're in very early innings in this artificial intelligence revolution, which will continue to show us more winners in tech and communication services.
We'll leave it there. Art Hogan, Chief Market Strategist, B. Riley Wealth Management. Always a pleasure. Thanks so much.
Great to see you.